$88. If you are holding silver or even thinking about buying it, you need to drop everything and listen very carefully to what I'm about to tell you, because tonight the game changes entirely. The sleeping giant is waking up, and the shock waves are going to hit your portfolio before you even pour your morning coffee tomorrow. Welcome back. Today is Tuesday, February 24th, 2026, and we are standing on the precipice of one of the most violent wealth transfers in modern market history. Tonight, the Asian markets, led by an absolutely ravenous China, come back online in full force, and they are staring down a silver market that is primed to explode to $88 an ounce. But here is the terrifying part. The next 2 weeks are going to be defined by engineered, ruthless pressure. Market makers are setting a trap, and millions of retail investors are going to be completely wiped out just days before the biggest breakout of our generation. I am going to show you exactly what this trap looks like, who is setting it, and how you can position yourself to be the one taking profits while everyone else is panicking. Do not click away, because what happens between tonight's market open and the second week of March will define your financial trajectory for the rest of this decade. I promise you, by the end of this video, you will see the silver market with total crystal clarity. Let us break down exactly what is happening right now. For the past few weeks, we have seen a simmering tension in the precious metals sector. Silver has been consolidating, winding up like a coiled spring. The mainstream financial media is completely ignoring it, distracted by the latest tech stock earnings and the usual political theater, but under the surface, a massive physical drain has been occurring. What you need to understand is that tonight, China returns to the global trading table. When the Shanghai Gold Exchange and the Shanghai Futures Exchange open their doors in the Asian trading session, they are bringing an insatiable appetite for physical commodities. We are not talking about paper contracts. We are talking about massive industrial conglomerates, battery manufacturers, and the People's Bank of China actively securing real physical silver. Why does this matter so much? Because the Western markets, London and New York, have been playing a dangerous game of musical chairs with paper silver for decades. They trade contracts representing silver that does not actually exist in their vaults. It works perfectly fine until someone demands the actual metal. Tonight, China is pulling the chairs away. They have been paying a premium for physical silver over the global spot price, creating a massive arbitrage opportunity that is draining Western vaults dry. When the East demands physical delivery, the West panics, and that panic is what sets the stage for our $88 target. But before you log into your brokerage account and throw your life savings into silver call options or mining stocks, you need to understand the hidden trap that is waiting for you over the next 14 days. This is the secret snare the institutions use to rob retail investors blind, and it happens every single time a major commodity is about to break out. I call it the liquidity flush. Here is how the villain operates. The big banks and institutional market makers know that silver is heading to $88. They see the same supply and demand data we do, but they cannot build their massive long positions if the price is already running away from them. So over the next 2 weeks, they are going to apply immense downward pressure on the paper price of silver. They will dump thousands of naked short contracts onto the COMEX during the thinnest trading hours, usually in the dead of night, to trigger flash crashes. They want to trigger your stop losses. They want to create red candles so terrifying that you voluntarily hand over your silver at a massive discount out of pure fear. They want you to believe the rally is dead. They shake the tree, the retail money falls out, and the institutions sweep it all up at bargain basement prices right before the actual physical shortage forces the price into the stratosphere. Do not let them steal your wealth. Let me ground this in 100% verified data so you know exactly what is backing this up. According to the latest figures from the Silver Institute and global commodities tracking databases as of early 2026, the global silver market has been in a structural, irreconcilable supply deficit for 6 consecutive years. We are consuming roughly 250 million ounces more than we pull out of the ground and recycle every single year. Let that sink in. 250 million ounces of deficit. Above ground, easily accessible stockpiles are being decimated. And where is it going? It is going into the new global economy. Let me ask you something right now, and I want you to answer down in the comments. What is your personal price target for silver this year? Are you looking for $50, $88, or do you think we crack triple digits? Let me know below, because the math is starting to point to numbers that used to sound crazy. Think about it like this. Imagine you live in a desert town, and there is only one water tower. Every day, the town uses 100 gallons of water, but the well only pumps 75 gallons back into the tower. For a while, nobody notices. The water keeps flowing out of the taps. People trade water rights on paper, pretending the tower is completely full, but eventually, the water level drops so low that the pressure stops. Suddenly, everyone rushes to the tower with their own buckets. The price of a paper water contract goes to zero, but the price of an actual bucket of water goes to infinity. That is exactly what is happening between the COMEX in New York and the Shanghai Gold Exchange. We are at the bottom of the water tower. Now let us simplify some of the jargon you might be hearing on financial networks. You might hear experts say the silver market is in backwardation. That sounds complicated, but it is actually incredibly simple and highly bullish. In a normal market, silver for delivery 6 months from now should cost more than silver delivered today, because you have to factor in the cost of storing and insuring it. That is called contango. But right now, we are flashing into backwardation. That means buyers are willing to pay a massive premium to get their hands on silver today, right this second, rather than wait a few months. It is the ultimate signal of a physical shortage. It means the big players do not trust that the silver will even be there in 6 months. They want it now. Look at the data from the solar and electric vehicle industries. In 2026, the latest generation of N-type solar cells requires significantly more silver paste than older technologies. China alone is installing solar capacity at a rate that baffles Western analysts, consuming well over 150 million ounces of silver annually just for photovoltaics. Add in the massive electrical requirements for artificial intelligence data centers, which require thousands of miles of silver-heavy conductive components, and the demand curve goes completely vertical. We are looking at industrial demand alone, completely eclipsing global mine supply. Every single ounce of investment demand, every coin, every bar, every ETF share has to be squeezed out of a market that is already mathematically bankrupt. But I have to be completely honest with you about the risks and the uncertainty here. Silver is notorious for being the most volatile, frustrating, and manipulated asset on the planet. The road to $88 is not going to be a straight line up. It is going to be a brutal, volatile roller coaster. The massive short positions held by major commercial banks represent an existential threat to their balance sheets. If silver breaks containment and runs too fast, those banks face catastrophic margin calls. They will fight this breakout tooth and nail. They will use every trick in the book, raising margin requirements, halting trading, and unleashing negative media campaigns to shake your conviction. That is exactly why I am warning you about these next 2 weeks of pressure. You are stepping into a financial war zone, and if you do not have the stomach for 5 to 10% intraday swings, you are going to get slaughtered. So let us take a breath and recap where we are, because the next piece of this puzzle is the most critical. We know China is coming back tonight, bringing massive physical demand to a market that is already starved for metal. We know the global supply deficit is worse than ever, driven by solar, EVs, and AI infrastructure. We know the price target based on historical technical breakouts and inflation-adjusted metrics points straight to $88. And we know, without a shadow of a doubt, that the institutions are laying a trap over the next 2 weeks to flush you out of your position before the rocket launches. If you have stayed with me this far, you are already ahead of 99% of the market. You understand the fundamental setup, but understanding the setup is only half the battle. The other half is knowing exactly how to execute your trades, how to protect your downside, and how to spot the exact moment the institutions flip from heavily shorting the market to going massively long. There is a specific trigger event waiting in the data over the next 14 days, a specific signal that will tell us the manipulation phase is over and the melt-up phase has begun. This specific trigger event, the exact signal that will tell us the 2 weeks of engineered pressure are officially over, is something hidden in plain sight. It is called the East-West arbitrage premium, and it is the single most important metric you need to be tracking right now. Here's exactly how this trigger works. When China comes online tonight, you need to watch the price difference between a silver contract on the Shanghai Exchange and a silver contract on the COMEX in New York. Historically, these prices trade in lockstep. But when physical supply gets critically tight, the East starts offering a premium. They say, we don't care about your paper price in London or New York. We will pay an extra 10, 12, or 15% just to get the physical metal on boats and shipped to our vaults. Right now, that premium is bubbling. Over the next 2 weeks, while the Western banks are dumping paper contracts to crash the spot price and trigger your stop losses, the Eastern premium is going to widen dramatically. The trigger event happens when that premium snaps. There comes a mathematical breaking point where industrial consumers in the West realize the COMEX has lost control of the global price, and they panic buy to secure their own supply chains. When you see the Western spot price suddenly gap up violently on no apparent news, ignoring the usual morning takedowns, that is your signal. The smart money is no longer shorting. They have flipped net long. The trap is sprung, the flush is over, and the countdown to $88 begins. But how do we arrive at $88? I am not pulling this number out of thin air to get clicks. We have to look at the historical precedent and the brutal reality of the gold to silver ratio. Right now, it takes roughly 85 to 90 ounces of silver to buy a single ounce of gold. Historically, out of the ground, it comes out at a ratio of about 8 to 1. For thousands of years of human history, the monetary ratio was set around 15 to 1. Even if we just return to the modern historical average of 40 to 1, and gold simply stays exactly where it is today, silver mathematically has to double. But gold isn't staying where it is. Central banks around the world, particularly the BRICS nations, are hoarding gold at a record pace to de-dollarize their economies. As gold pushes into new all-time highs, silver acts like a golden retriever on a massive bungee cord. It lags behind its master for a while, building up immense kinetic energy, and then it snaps forward violently, overshooting gold's performance entirely. In 1980, silver hit $50. In 2011, silver hit $50 again. We are now in 2026. If you adjust that 1980 $50 high for the catastrophic expansion of the M2 money supply and real-world inflation, $50 is a joke. $88 is actually a conservative mid-cycle target for this specific commodity supercycle. It is the level where the massive multi-decade cup and handle formation on the long-term charts finally resolves. When we break through the $50 resistance, which has acted as an iron ceiling for over 40 years, there is absolutely zero historical resistance above it. It will be an absolute vacuum. Price discovery will be violent, and it will be breathtaking. So, the energy in this market is going to completely shift. We are moving from a state of artificial suppression to a state of absolute panic buying. Let me slow down for a second and bring this back to you right now, sitting at your computer or holding your phone. What are the actionable steps? How do you actually survive the next 2 weeks of orchestrated pressure and position yourself for the $88 run? You need a clear 3-part battle plan. Step number 1 is securing the foundation. This means physical metal in your own possession. If you do not hold it, you do not own it. Counterparty risk is the hidden killer in the modern financial system. When the paper markets freeze and the exchanges declare force majeure because they cannot source the metal they owe, your physical silver coins and bars will become the ultimate safe haven. The premiums on physical silver might seem high right now, but a $5 premium on a coin is going to feel completely irrelevant when the spot price is crossing $70, $80, or $90. Step number 2 is the paper strategy, but you must be ruthless about what paper you hold. If you are buying a silver ETF, you have to read the fine print. Vehicles like the SLV are famous for changing their prospectuses during times of crisis, basically admitting they might not actually be able to get the silver to back their shares. You need to look into fully allocated, audited trusts. Many smart money investors look toward the Sprott Physical Silver Trust, ticker symbol PSLV, because it represents fully allocated metal stored safely in the Royal Canadian Mint, far away from the sticky fingers of the COMEX derivatives market. Step number 3 is the leverage play. This is where explosive wealth is made, but it is also where the risk is highest. I am talking about the silver miners. The companies pulling this metal out of the ground have been beaten down, ignored, and starved of capital for a decade. Their profit margins are deeply compressed because the cost of fuel and labor has gone up, while the manipulated price of silver has stayed low. But think about what happens when silver breaks $50 and runs to $88. The cost to mine an ounce remains relatively fixed. Let us say $22 an ounce. If silver goes from 30 to 60, the price of the metal doubled. But the miner's pure profit margin goes from $8 to $38. That is nearly a 500% increase in pure profit. That is why high-quality senior and mid-tier mining stocks can act like call options on the silver price, offering you 3, 4, or even 5 times the percentage gains of the physical metal itself. But remember the trap. Remember the 2 weeks of pressure. The market makers want to crush the mining stocks over the next 14 days to shake you out. You must hold your ground. If you deploy all your capital right this second, a 10% engineered drop next Tuesday is going to cause you immense psychological pain. The smartest players are keeping dry powder. They are holding cash in reserve. When the big banks engineer those terrifying 3 a.m. flash crashes over the next 2 weeks, you do not panic sell. You use your dry powder to buy the blood in the streets. You become the predator, not the prey. Let us do a final reality check and loop this all together. We started this video talking about the massive shift happening tonight as China re-enters the market with an insatiable appetite for physical commodities. We laid out the cold, hard facts. A 250 million ounce structural supply deficit driven by explosive growth in solar, electric vehicles, and AI. We exposed the dark reality of the paper manipulation on the Western exchanges and the exact trap the institutions are laying over the next 2 weeks to steal your position. We covered the explosive east-west arbitrage trigger, the historical rubber band effect of the gold-to-silver ratio, and a concrete three-step action plan to protect yourself and profit using physical metal, allocated trusts, and high-leverage mining stocks. The pressure cooker is completely sealed, and the heat is turned up to maximum. The next 14 days will separate the emotional amateurs from the calculated professionals. If you understand the macro data, if you see the deficit, and if you anticipate the manipulation, you cannot be shaken out. If this deep dive opened your eyes today, you have to hit the like button right now so the algorithm pushes this warning out to other everyday investors before the institutions pull the rug on them. Subscribe to the channel and turn on the notification bell, because over the next 2 weeks of extreme market volatility, I will be posting real-time updates the very second we see that East-West premium snap and the final melt-up begin. You do not want to be out of the loop when the algorithms flip. Drop a comment below with your exact entry strategy. Are you stacking physical, loading up on PSLV, or hunting for mining stocks? I read every single comment, and the community needs to hear your game plan. As always, remember that I am a financial commentator, not a licensed financial advisor. This video is for educational and entertainment purposes. Silver is a highly volatile, completely ruthless market. Never invest money you cannot afford to lose. Do your own rigorous due diligence, and never blindly follow anyone on the internet. Protect your capital, protect your family, and stay frosty over these next 2 weeks. The real fireworks are just about to begin. I will see you in the next one.